While many of us participated in and won IPO lotteries last year, do you know who really created the majority of the wealth? The ones who had invested in these companies much before they went public. The ones who identified the jewels well in advance. 20% of the total IPO amount in 2021, which is 24,106 crore rupees, went into the pockets of private equity and venture capital investors. And 27%, which is 31,704 crore rupees, went into the pockets of promoters of the company. Yes, 47% of the amount that you and I, the retail investors, poured into the IPOs was an exit opportunity for the real early investors. And let's not even get into how much wealth they created on the securities that they must have held on to even after the IPO. Wondering why you are not a part of this early investor club? And is there a key to unlock it? Turns out there might be. How do we know? Read on. Hi, this is Revolution Read On, a daily podcast where we break down one story from the world of business and finance. Here's your story for today. Listing on the stock exchange brings with it a lot of fanfare and drama. But not everyone wishes to be in the spotlight, and there's a good reason for that. Just like we grow from children to adults, companies also go through a life cycle. At each stage, it has a different set of needs. It is upon the investors and the promoters of the company to take care of these needs. The early years are especially crucial. The company needs freedom to create a unique and robust business model. It needs to find itself by experimenting, by falling down, getting up, and falling down some more. This is how legends like Nika, Latent View Analytics, and Happy Minds are made. And this is also how the early stage investors earn a fortune. But this is also why such companies don't have the bandwidth to deal with the scrutiny that comes with public markets. So, when companies are in the work in progress stage, they prefer raising money privately, and mostly from investors who would pour in a large sum. While all of this makes sense, is there a way in which we, the small retail investors, get in on this growth action? And more importantly, how to figure out if a company is going to make it big in the future? It's very easy to look back and mourn over missed opportunities. But if you are a serious investor, it's your responsibility to dive deep and understand the nuances of the business. But how do you dive deep into these companies? Where will you get the information? You see, the companies that are listed on the bourses are required to submit annual reports and other documents. That's not a mandatory ask for companies in the private market. So, not all companies disclose such information. This makes it harder to arrive at a decision to invest in them. Even if you figure out a company you want to invest in, how the hell do you do it? Every transaction needs a buyer and a seller. Where to get these sellers? Surprise, there are many places to find one. Number one, ESOPs. What better investment than earning your way into the company when you are part of its growth story? But you will be limited to that one company only. Number two, private placements. Want to buy shares from the promoters themselves? This route involves brokers, wealth managers, investment banks, yada yada. Number three, portfolio management services or PMS. This is the mutual fund equivalent for unlisted shares. Sounds like the perfect deal, but only if you have at least 50 lakh rupees in your kitty. Number four, alternate investment funds. This vehicle is similar to PMS, only that it first pools the investment and then takes the investment decision. The only drawback, you need to shell out at least 1 crore rupees to avail this facility. All of these methods have something or the other that makes a retail investor turn away. Isn't there any butter smooth process to analyze and invest in the private markets which won't cost an arm and leg? Yes, there is. Stay tuned as we unveil the trump card in private market investments tomorrow. Spread the word, the revolution is on.